So, do you think that you need a lot of savings to buy your next investment property, or are you currently saving really hard to buy your next investment property? If you are and you have a property right now, I think you should really listen to this. If you have a property already, whether it's your principal place of residence or if you have investment properties, it's very important that you understand what equity is and how to utilize equity to the best of its ability. What equity is what your property currently is worth minus the debt that is currently owing against it, and the difference between the value and the debt level is your equity. Now, what's important though is you generally can't use 100% of your equity. Under normal circumstances, someone could use 80% of the available equity. So what's important though is you understand what is your usable equity. So usable equity is 80% of the property value. However, based on the usable equity, you also have to minus off any existing debt against that property. So for example, if you have an $800,000 property, the usable equity there is $640,000. So that's 800,000 times 80%. That is your usable equity. However, if you have a debt owing against that property, let's call that $400,000. So your usable equity being 640, your debt being $400,000, your remaining available equity for you to use is $240,000. So that's the equity that you can work with. However, there are some instances where you're able to use more equity. One, if you're happy to pay lender's mortgage insurance and borrow more than 80% of the usable equity, that is one option. There are also certain professions where some lenders would allow you to go up to even 90% of usable equity or 95% depending on your professions. So it's very important that you check with your mortgage broker to see if you do qualify for them, because that can potentially mean that you have more usable and available equity. So now that you have worked out the usable equity and available equity, how are you going to use that equity strategically to scale your portfolio? One of the most common way investors use equity is by borrowing 20% of the deposit that you need for the next purchase plus the purchase cost. Here in South Australia, that's about 6%. So you're really borrowing 20% plus another 6% to assist you with avoiding paying lender's mortgage insurance in your next investment property. And that's also helping you to maximize your good debt. Those are debt that are tax deductible, rather than using your own savings or you saving up really hard for a 20% deposit plus the purchase cost. You're using equity that's available there. Another way investors strategically use their equity is to debt recycle. So this is more commonly where you have your principal place of residence, you have been building up your offset, you've been building up your savings or your redraw for a very long time. Now, you don't want to be taking out those money to then use for your next investment property, because that will still open you up to your debt being not tax deductible for the 20% deposit or the equity that you're using. What a lot of investors strategically do is that they would use, let's say if you have $100,000 sitting in your offset account or your redraw account or your savings, you would then pay off the debt, which is your bad debt against your principal place of residence, pay down by $100,000 and draw it back out as an investment debt as a separate loan split. When you draw out that as an investment debt, that debt then becomes a good debt. Once you've bought an investment property, that becomes a good debt, and that's how you would want to debt recycle and strategically maximize your good debt. So now that we've covered the two key ways of how investors strategically use their equity, how are you going to access the equity? So what you want to do here is that if you already have a property, you know that it's grown in value over the past few years, you want to reach back out to your mortgage broker or the bank to then work out what the valuation of the property is. Now, one key important thing to note though is that every bank will value your property differently. So one bank might value your property at $650,000, one bank might value it at $700,000. We've definitely seen a big disparity between valuations across multiple different banks. So if you're really after equity, sometimes asking your mortgage broker or the bank themselves to then value your property and see which one comes in highest might be the best way to then maximize your available equity. One key thing to note though is that if you're drawing out equity and you're using it to buy your next investment property, very important to make sure that your loans are not cross-securitized. We'll talk about cross-securitization and how it actually impacts your property portfolio in a separate video, but that's just something for you to think about. You definitely don't want your loans to be cross-secured. So that's in a nutshell how you want to use your equity to scale your portfolio strategically. If you have any questions in terms of how are you going to move forward from here on in terms of utilizing your equity to scale your portfolio, reach out to us here at Rising Investor and we're more than happy to help you.